Hello, I'm Albert Liu. Today is Tuesday, February 25th. You're watching the Power and Market Report. Well, growing concerns over the coronavirus have stoked investor concerns of a global economic recession. Stocks dropped roughly 6% over the last 2 days, with the NASDAQ dropping into negative territory for the year. WTI crude entered a region below $50 a barrel as investors fled to the safety of cash, bonds, and gold. Joining me now from Dallas, Texas to comment is Don Luskin, the Chief Investment Officer for TrendMacrolytics LLC. Don, very good of you to join me on short notice. How are you doing today?
I'm doing great, considering that there's death and disaster all around us. How are you?
I'm the same, Don, the same. Now, last time I spoke with you was at the end of 2019. I asked you specifically what you thought 2020 held. And I recall you said that, look, it's shaping up to be a good year unless something really bad happens that rocks oil prices, for example. Are you happy with it? Does this qualify?
Yeah. It's we certainly have had oil prices rocked, and it's a funny thing. You know, we normally think about the oil shocks as being shocks on the supply side. This is a shock on the demand side. China is the only country in the world where oil demand growth is actually happening. And it slowed down a lot during the trade war. And now we haven't even seen statistics yet because it's still so new. But we know that demand growth is going to be negative in China for oil because of the lockdown of its economy to hold back the coronavirus. So the oil market came into this already in a glut condition. And it's just sort of a miracle to me that we're even holding prices right around 50. The whole economy not only runs on oil, but oil is a big industry in the United States and everywhere else. Petrodollars supply liquidity to the world. In the United States, the oil industry is very highly leveraged. 17% of the high yield bond market is issued by frackers. A lot of leveraged loans are to frackers, huge bank loans to frackers. This is where the coronavirus thing could get financially systemic.
Right. And so oil hovering around $49.80. Don, we actually touched on that last time, and that is the participation of the U.S. oil industry in the high yield markets. I'm wondering, are we seeing stress in those markets yet? And do you expect to see stress in those markets if these prices persist?
We're already seeing the early signs. We've seen spreads to treasuries blow out in the high yield market energy sector by a couple of percentage points. So that's the warning sign. And at a price like 50, these companies, they're either profitable or survivable. But remember what happened in the first quarter of 2016 when the oil price was about half of where it is today. Double bottomed at 26, first in January and then again in February of 2016. And at that point, the spread to Treasury in that bond market blew out to 20%. That was a true shutdown crisis. And when that happens in a large sector of the high yield bond market, that becomes contagious, not to use a loaded word nowadays, into other elements of the bond market, into the bank loan market, into the credit system in general. And when that kind of thing happens, if it doesn't repair itself right away, like thank God it did in 2016, that's how you get recessions.
Right. And, I dropped a phrase on you last time, global synchronous slowdown. It's sort of a buzzword. But this is one of the ways you could get one, correct? I mean, this started in China. You see it firmly entrenched. I'm talking about the virus, firmly entrenched in Europe now, at least in Italy. And it has literally locked down the Chinese economy. The people are not going to school. They're not going to work. If this were to spread much further, you could get a synchronized recession. And it's not that I saw this coming. I absolutely did not. But this is certainly one of the ways you could get there, isn't it, Don?
Oh, are you telling me that in our last interview, I didn't predict that there would be a global pandemic called COVID 2019? I could have sworn I said that.
No, I'm hinting that. Correct.
Okay. This has the potential to be more than a global slowdown. This is a global lockdown. And
Right.
I just want to put out there that those may be just very distinctly different things, and a lockdown may be better than a slowdown. A slowdown is something that nobody does on purpose. A recession is just something that happens to you. Now, obviously, a pandemic or a would-be pandemic isn't something you want either. That just happens. That's truly a bolt from the blue. But when you lock down a city or a province or a whole country like China's locked down in order to prevent it, that is something you do on purpose because you think it's a good cause. It's kind of the moral equivalent of war. It's seen as something that's, fine, we'll have a really bad month or a really bad 6 weeks or, God forbid, a really bad quarter, but we're going to save millions of lives, and we think that's worth it. And then when that's done, it's done. And we've all been in it together. It's been a great and glorious crusade. And we had to shut down that factory for a month, but all the machines are still there. And none of the workers have moved away because we forced them to stay home. And so they can just come right back to work. And not very many of them have died because this virus is really only picking off, very old people who probably weren't working in the factory anyway. So when a thing like this is over, it's decisively over. That isn't what happens when a recession is over. You don't even know when a recession's over. When you try to restart that factory after recession, you find out that, let's see, the third month that factory was in receivership, somebody sold all the machines. So we actually can't turn that on. And half the workers have moved away. And the workers who are still around are the ones with no skills. So it's hard to get out of recessions. It's actually easy to get out of emergencies. Recessions are divisive. Emergencies are unifying. And economic activity, animal spirits, is very strong when people are unified. So for the time being, if this lockdown doesn't truly have to go global, and if it doesn't last for more than a month or two, then we will power out of this and we'll just make up for lost time, and you'll look back on it, and the humanitarian toll will be tragic. Several thousand people will die, but the economy will roar right along. I think that's the default scenario still, Albert.
I think that is not only the default. I think that is an optimistic view. If you look at the stock market down almost another 1,000 points today, gold has been ratcheting up. Although it gave back some of that today, it has been ratcheting up through these various crises. And I'm wondering if the market is not pricing in your default or best case scenario. What if it's not one or the other, default or an emergency? What if it's a recession or emergency? What if it's an emergency that triggers a recession? Meaning that the fact that people are at home actually triggers a recession in the sense that there's some liquidation required, unemployment ticks up, and then we're into this thing that you said is the worst of the two, which is a true economic recession. I'm wondering if the market is concerned about that because it seems to be jittery, more so, not taking the calm approach that you're sort of laying out right now, where you just look past something that's horrible but will inevitably end. It seems to be a little bit more concerned than that. What do you think?
Well, fair enough. I mean, you said a lot of things. Let me try to address as many of them as I can remember. Gold has certainly been a big winner during this period. I think there's sort of a panic premium that gets built in. It's curious that gold was up so strongly on Monday, down strongly today. That's quite curious. But I would also point out with gold that gold has been in rally mode before anyone heard of coronavirus. So there's something going on with gold that probably has something to do with global monetary liquidity conditions, upon which the coronavirus thing is just frosting on the cake. But that's a story that remains to be seen. As to equities, the kind of correction that we've seen in U.S. equities, well, actually, in fact, global equities, what I'm about to say is generally true for equities around the world. We came into this at all-time highs. So you could say that equities were ready for a correction for any reason or no reason. And this is a heck of a reason. And it's actually kind of amazing that just a week ago, U.S. stocks were still at all-time highs. And it was just kind of weird that back in 2014, when we had just a couple hundred deaths globally from Ebola, there was a 10% global stock market correction, including in the United States. A very strong reaction. In 2013, in the SARS, the first coronavirus, 6.7% correction in U.S. equities. It was weird that we didn't get at least some kind of correction this time. Well, now we did. So here you go. Stocks have to take on board some degree of worrying about the worst case. Now, I'm going to say, why did stocks wait so long? I'm going to say something, maybe a little provocative, and I hope everybody can keep this in context. But we had tens of thousands of infections in China. and a couple thousand deaths, and the stock market kind of shrugged it off, went to all-time highs. Then over the weekend, you get a couple hundred infections in Italy, dozen deaths, and all of a sudden it's worth a 6 or 7% correction. Well, Albert, I don't know quite how to say this, except I'm just going to say it straight out. It seems like the stock market woke up to the fact that the coronavirus can afflict white people too. And all of a sudden, it became really real. I think that's what happened. I think it was a shock of recognition. And we're just going to have to digest that. I think markets tend to overreact when they get new information like that, or a new emotional dimension on old information. And we'll see. Because if you look at it by the numbers, the number of infections outside China is still incredibly small. It's like 2,500 as we speak. The number of deaths outside China is 37 as of this moment. So we've got a mortality rate outside of China of only about 1.5% and a tiny population of infected people in the grand scheme of things. 2,500 people out of 7 billion, right? So I'm telling you, the idea that this is somehow going to be a new plague that sweeps the entire planet, not yet. And you can say, well, Don, don't get complacent because of those phony statistics coming out of China. I read Zero Hedge, and I know that China's lying about this, and there's a bioweapons factory nearby, and they're incinerating hundreds of thousands of corpses. You've heard those ridiculous stories. Well, the numbers I just quoted are the numbers outside of China, reported by honest, diligent people like the Japanese, like the Italians, like the US itself. So these are good numbers, better than the Chinese numbers, and they don't look all that fearsome.
I think one of the concerns, certainly, I grant what you're saying, but maybe one of the concerns on top of that is the fact that I don't think we understand how the virus got where it is. And I think they're grappling with still trying to understand the transmission mechanism here, perhaps, or to understand what measures are going to be necessary and understand how long it's going to take for a vaccine to be developed. I think the level of uncertainty we have, given, I guess, the newly appreciated seriousness of this thing, is something that we're not comfortable with. And so we're selling off.
Yep. Well, we've got unknown unknowns, for sure. Lots of it.
So where do you see the risks now, Don? We have to update what we talked about before. You must be more concerned about the high yield market. How concerned are you about stocks taking, say, another 5-10% downward pullback in the next couple of weeks?
I think that's certainly conceivable. That would be within the scope of the kinds of reactions that equities have to this kind of event, especially when you're starting from all-time highs and valuations weren't exactly compelling, were they? So I guess this is the kind of thing you just sort of have to expect. On the other hand, I think the whiff of panic is in the air. The whiff of crazy talk is in the air. When people, seriously start saying that this is an escaped bioweapon and that the Chinese are incinerating thousands of corpses, that's just nutty. And you hear people say things like this right at tops and right at bottoms. And, when you get peak crazy talk, then the thing's over. So I think we've probably seen the worst, Albert.
That sounds like peak crazy. And so what specifically are you telling your clients now, your research clients of Trend Macro? Anything specific that you can share?
Well, sure. I'm basically sharing with them the actual statistics about the progress of this thing in terms of the spread of infection and the deaths resulting from it. And I'm trying to get them to look at the actual hard numbers outside of China, which are just amazingly low. And I'm trying to say, okay, look at these statistics, and let's say this was the flu. What would you think? Well, what you'd think is this is the teeny tiniest, most insignificant flu season in history. That's what you'd think. In fact, every single year, the flu is global. It sickens hundreds of thousands, millions of people worldwide. Tens of thousands of people die every year from the flu. And I don't mean to be cynical about it, but most of the people who die from things like this are people who were at risk or compromised in other ways. They're very old people, or they're sick people, or people with compromised immune systems, or with diabetes, or exhaustion, or undernourished, or something. That's one of the reasons why so many healthcare workers in China have been dying of it. It's because for a month they haven't slept. And it's because they get no treatment. They give treatment. They don't get treatment. And other than that, most of the people who've been dying were old and sick anyway. Now, I don't mean to be cynical about it. I mean, their lives are worth as much as anybody else's. And it's a tragedy when their life ends for any reason. But at some point, you have to say, okay, well, just actuarially, you didn't have that long anyway. And if it wasn't going to be this, it was going to be something. So how much economic damage do you want the world to take to contain a disease that isn't really worse than any other disease? Because it costs lives if you cause a recession. If somebody loses their job because of this and they don't have the resources, then what might happen? Let's see. They feel a pain in their stomach. And if they had their job, if they had the resources, they'd go to the emergency room and, oh my God, it's a ruptured appendix. But I'm just going to live with it for a couple of days because I don't have the copay. Well, you're going to die because of the recession. Not because of coronavirus, but because you didn't have the money in your pocket. So if we deliberately cause a recession to save some lives from the coronavirus, we're just going to be throwing away other lives that aren't counted. Now, because they're not counted, that's a perfect thing for a bureaucrat, because they only take blame for the deaths that are counted, not the deaths that aren't counted. So what I've been telling my clients is worry more about what the bureaucrats do than about what the virus does.
Don, when you say intentionally create a recession, are you talking about sort of draconian measures by the governments in terms of shutting things down? Are you suggesting that's a bad move?
Yes, I'm saying that too much of that for too long, where it isn't strictly necessary, would be a costly economic mistake. And when I say when I use the word recession for that, well, if you lock down like a city in northern Italy, for a week or two, that's not going to cause a recession. I guess you could say that's a low cost, prudent thing to do. But let's say you some bureaucrat in Italy just decides he wants to have a total CYA policy, and he just shuts down Italy, for a month. Well, Italy's been flirting with recession for the last 25 years. So, okay, it's ready to go. And so that would be deliberately causing recession. Mm-hmm. And if there wasn't a darn good epidemiological reason for doing it, that would be a really dumb decision.
Makes a lot of sense, Don. We're out of time, but thank you very much for joining me on short notice. And as this thing progresses, I hope we can check in with you and keep an update on the markets that way.
Anytime, man. Let's do this again.